Good morning, good afternoon, good evening, wherever you are in any part of the world. As I told you, we have started lecturing on accounting. The first video went already introduction to accounting. So on an introduction, we're gonna look at the purpose of financial reporting, the types of business entity, the users, the government, the main financial statement. And in this chapter, as I stated, the financial statement shall be prepared, the different type of business entities, and the use of financial statement. We're going to look at the financial statement, the statement of financial positions, and income statement. And the cash flow shall be handled after. And mind you, this is for the beginner, and this is for the people who like to refresh their accounting knowledge. It would be good to work with us this journey. So let's have a look at the types of the business entity. Just a summary part of it. We have the sole trader. The sole traders refers to the ownership. The sole traders can also have the employee. It's a type of business entity which is owned by a person, and this type of business can also have employees, but it is distinct in just a way that the individual who opened this business is personally responsible for the debt of the business. In case you incurred some debt and you have not yet paid, you are responsible for it. You can be sued. That is what it means. But it can have also the books of account. You can prepare your books of account. But this is what would make it a little bit unique from other types of business. And it doesn't have an activation in Sana, meaning that you and the business, you are treated like you are the same. The business is not a separate entity from you. Legally, in case you default, you can be arrested, you can be sued, because you are responsible for the debt. In case of suing, you'll be sued in your own name, not the business. The second type of the business is partnership. As we know, this is where two or more people work together to form the business, and in order to earn profit. Mind you, when we talk about business, you should ring into your mind should ring into the purpose is to earn profit. So when two or more people agree to come together to form the business in order to work together to earn profit is called partnership. Earning profit is where your income is more than your expenditures. That is how profit is calculated. We are going to look at all those stuff later on. The third broad categories of business is the limited liability company. Here, owners have liabilities limited to the amount they pay for their shares. Let me explain this. It means that if we are three in a company, we have somebody called Dorothy, somebody called Samuel, somebody called Isaac. If the shares of Isaac is 100,000 US dollar, Isaac cannot borrow beyond 100,000 US dollar. If the amount of shares for Isaac in a company is 100,000, he will never borrow beyond that amount. Why? Because in case of any liquidation, in any case of any problem, he cannot get money from elsewhere. So the capital, the share capital in a company is being used as a surety, as collateral for borrowing. That is literally what they mean. Secondly, also, a limited liability company as a separate legal entity from its owners. Remember when I was explaining sole traders? I said sole trader, you have a business and himself, in a legal term, is the same with the business. They are treated the same. The business is not treated separate from him. Because now when it comes to payment of debt, he is responsible. The laws allows him to be sued so that the money is collected. While in limited liability company, a separate legal entity from other business is different, my friend, and the directors are different. In case now the company defaults or have the debt to pay, you don't sue the directors, you sue the name of the business, and the directors now have now to use maybe their own lawyer to stand for them. That is what it means. Legal entity, the term which I call it artificial insana, meaning the business is like a human being existing of its own, with its own structures, its own name. So that is that. That is about the broad category of business entities. Yes. So let's proceed. So we were looking, and let's also look at the purpose of financial reporting. I think also it's very important. Let's not skip this. It is something which is also interesting. Let's discuss something there. The purpose of financial, why do we need to prepare, struggle ourselves to prepare the books of account or talk about financial reporting? Is it really relevant in this world of ours? So let's get the reason there. A business has a number of functions. The most prominent is to make a profit for the owners. If you don't record, if you don't prepare those various books, how are you going to determine your profit? Because your ultimate aim is to make the profit. But this profit comes when you keep data. When you process the data, you summarize the data to be understood by the people who doesn't know accounting. Remember, in a company, in a business, we have section of people. We have you as the directors there. We have the employees there. We have the board there. We have the government there. We have many people feed from that business, or many entities feed from that business. They are all interested in this data of yours. So the main reason why we prepare financial reporting is to simplify, to echo out, to bring on the table the data which people can make decision on. We are going to discuss this very shortly. So profit is the excess of income over expenditures. I explained that already. There's something very interesting here, down here. My brothers and sisters, this is how the flow of financial accounting is. This is the whole thing, how it starts and how it ends. Financial data. From financial data, we come to the books of prime entry. From the book of prime entry, we come to ledger account. From ledger account, we come to trial balance. From trial balance, we come to financial statement. Let me explain. How do we generate financial data? We generate financial data by selling and buying. Buying. When we sell or when we buy, again it is into two subsections. We can sell on cash, we can sell by credit. So when you sell By credit, you incur debt. You have to enter that book. We have to enter that sales. We have two types of sale: cash sale and credit sale. Credit sales, you enter it into the purchases book. Cash sale, you enter it into the cash book. Remember, we are already moving. When you buy things from outside and you have not paid, you enter them into purchases day book. When you supply goods outside and it is not yet paid, you supply outside, it is not yet paid, you enter it into your sales day book. And it generates what is known as receivables. It generates what is not receivables. Receivable is the least or the amount of money that you expect people to pay. When you collect goods from company A and you are selling on credit, you enter them in purchases day book. You generate what's known as payables. Remember, we already talking about how data is generated. So those data now are entered in the books of prime entry. The book of prime entry are the book of original entry, meaning that these are books where we first enter the prime data, the first data. I have told you, one of them is the cash book. There's when you sell on cash. One of them is the purchases day book, when you buy on credit. One of them is a sales book. That is when you sell on credit. Remember, I talk of two terms now: receivable and payable. Another one is called journal. Journal is when you cannot enter any of these data in this prime book, either cash book, either purchases book, or sales book. You can enter into journal. Journal is actually used for when you make error in any of these books, you can correct it in journal. So journal is a general ledger that we use for corrections. So then we have the ledger account. But if we talk about the ledger account, that's, for instance, you made a sales. You made a sales on cash. You made a sale, cash sales, and you excuse me, you made cash sale or you made the credit sales. You now need to open the ledger account. The person who supplied you with a good is called a creditor. It's called creditor, and sometimes we call it payable. You open the account of that very person or of the name, in the name of the business. These are what we now call it the accounts. These are what we now term it what? The accounts. We have the credit account, we have the debtor account, we have receivable account, we have purchases account, we have sales account, A, B, C, D, E. This is now what we call it the ledger accounts. The ledger accounts. Then from the ledger account now, the extract, the balance of this account, we take it to the trial balance. Trial balance is a list of account balances. The debit and the credit list of account summarized together, and the two sides have to balance, the debit side and the credit side. From the trial balance now, that's where now we prepare now the financial statement. The financial statement has a lot of components. Financial statement the financial position of the business, the cash flows, the ratio analysis, all now come from trial balance to financial statement. This is where we now end the accounting. Financial statement, books of prime entry, ledger account, trial balance, and financial statement. I mean to say financial data, books of prime entry, ledger account, trial balance, and financial statement. We're going to look at them one by one into detail. So thank you so much. This is just a brief introduction. It's just a small part of it. So let's continue. Subscribe and stay tuned. All the notes is summarized. As I will be speaking, I will be showing for you all those information. Have a lovely day. Great. Share this video with your colleagues so that other people also get to learn. It's very important. We are doing business. I can teach you even if you have not studied accounting and simplify things for you so that nobody sees you. Thanks.